Well, thank you very much. I'm real excited today to get into this advanced tax planning webinar that me and some colleagues here in the New Orleans market have been working on to just give value to you out there that are frustrated and tired of just paying too much in tax. So I'd like to welcome all the guests on this webinar, and hopefully you can see that the approach we're going to go through today is not reactive to taxes, but very proactive. In today's world, with financial bailouts, government out of control spending, economy shutdowns through pandemics, and financial mismanagement in DC, it usually is going to spell one thing. Many of you listen to our voices today are going to pay more taxes than you should unless you have a very solid proactive CPA that I'm going to introduce you today, and two, a team around you, your business, and your family's wealth, ensure that all your hard work doesn't end up going to the wrong people. I'd like to introduce you to two of my planning partners today in a family office we're building, Stephen and Tyler Johnson. How you guys today, man?
Doing good, Jack. Thank you.
Awesome. Thanks, Jack.
Yeah, their accounting firm has worked with businesses for over 100 years. This year they're celebrating in the greater New Orleans area. And I recently sent them a client that through their expertise and ways of looking at taxes different, they saved a client nearly $30,000 a year in how they're classifying and setting that entity up that they now keep in their pockets versus sending to the folks in DC. So with that being said, I want to introduce these two gentlemen quickly to you. So welcome first and foremost. Stephen is a graduate of Southeastern Louisiana University. He started his career early on at Coopers and Lybrand. He joined his former partner in 1991 and became partner himself in 1993. He's a licensed CPA in Louisiana and also holds a PFS designation to be able to testify in court cases. He's an avid LSU fan, Saints fan, devoted father and husband. Tyler, he's a graduate of LSU. Go Tigers! That's hard to say for a volunteer, I can tell you. He started off with KPMG and Ernst & Young to really cut his teeth with some of the big six. So now, what are they? Is it the big three now, basically?
Still four.
Still four.
And
he interned with the firm while in college to later join Busenlener and Johnson in 2016. He's a licensed CPA, avid LSU fan, Saint fan, craft beer lover, fantasy football guru, and devoted husband. So guys, thanks again for taking some time and really jumping into why we're doing what we're doing. The goal of this is really simple, right? It's to take advantage of the financial instruments in the tax code to pay the least amount possible. Don't want to add anything on that as we get started?
No, I mean, that's basically what our goal is, is we are more proactive than reactive. And we like to, look for ways to save our clients money and taxes and take advantage of the tax laws as they're written by Congress. And so that's why we differ ourselves from our competition.
And Jack, just to add to that, you got to think, just in the last 2 years, we've had multiple stimulus bills with these COVID relief bills. There has never been more just frequent, massive change in the tax law than there has been in the past 2 years. And even before that, the biggest tax reform we had since the 80s was when Trump first got into office. So, trying to keep up with this stuff, even as a tax professional, can be a bit overwhelming. So, certainly we're always trying to add value to our clients and adapt to the always changing environment.
That's good. When they enacted taxes, they said it was going to be a 1-year deal. Liars, right? And and even the gentleman, the Supreme Court justice at that time, said it was up to the individual to do their due diligence and this work. But as you said, Tyler, it's difficult with all the changes. So there's a bunch of different strategies. We'll first start off with tax deductions. Who wants to jump in on this one?
So for the tax deductions, obviously for individuals, we're talking about some of the basic tax deductions, your itemized deductions, which are going to be, mortgage interest, property taxes, charitable donations. The IRS kind of eliminated some of the other unreimbursed business expenses if you're a W-2 employee and stuff like that. So But then you have, besides itemized deductions, you'll have some education deductions or education credits. Then when you have a business, then we get to a lot more availability and pass through entity deductions, qualified business income deduction. And of course, even with individuals' tax returns, if they have a business or rate associated with it, we could have some unreimbursed business expenses directly against K1 income and stuff like that.
And you want to talk about the credits a little bit, maybe Tyler or Stephen going to jump in on this one?
Sure. So tax credits, generally speaking, are more valuable than deductions, very simply because a tax credit reduces your taxes dollar for dollar. It is literally a credit on your taxes, as opposed to a deduction, which you're deducting from your taxable income, but then your tax is still calculated. So if you're a 25% tax bracket guy, you need a $4 deduction to make that worth a $1 credit, just as some simple math there. But there's a lot of tax credits out there. So obviously dependent credits is a big one now. And that's something that the numbers also just went up depending on your situation. You could be getting $2,000 per child from that. You could be getting as much as $3,600 per child advanced to you throughout the year now, which is a very new change that's been going on as well. There's also such thing, depending on, again, your income, your situation, there are earned income credits. There are credits for contributing to retirement plans if you're not a very high earner at this time. You've also got education credit. So if you are paying your own way through college, if you have a kid that you're paying their way through college without using 529 funds, those can be some very lucrative tax credits coming back to you for that higher education.
Well, that's awesome. And I guess, the goal here is really to get people that know what they're doing. That's why we're having this webinar. I mean, if you ask Tyler and Stephen to, pull apart your car and check out the engine and all, I think they would not be well versed in that, but this is their expertise. And share a little bit about what makes you guys different. And I know, Stephen, we met a couple years ago through an introduction about why you guys are the expert in this field.
I mean, it goes back to just, we do a better job of sitting down with our clients and digging into their information and again, being more proactive and seeing what would work for them instead of your typical CPA come the end of the year, just receive all their information and prepare a return. So we do lots of planning throughout the year to try to take advantage of all the new tax laws that are coming out and stuff like that. And just analyzing our clients' information to see, this tax season alone, we had a minimum of 4 tax changes that affected during tax season. Congress has never done this to us before. So then after tax season ends, we're analyzing all of our clients and seeing which ones should have been able to take advantage of some of these tax laws that the Congress didn't change until after the returns were filed. And so we went back and we went client by client and figured out the best way. Whether it was anything for us or not, didn't matter. It was going back to take advantage of this for the clients.
So you need to ask yourself, you think, you listening to this, is your CPA really doing that, putting you into pools, thinking about all the changes, or are they just crunching numbers, telling you how much to write a check for and sending you out the door? And that's when I did meet the Johnsons, what really impressed me with them is they were already doing things and they've just expanded and are expanding upon that.
And Jack's helped us expand on that.
Well, yeah, I mean,
when we say experts, he's bringing us even a little more of a toolbox to have access to some other things that we used to just pass off to other people. And now we're getting even a little more in depth into it with our clients as a result of having access.
It's constant learning, right? I mean, there's no way, and if you're the smartest guy in the room, you're probably in the wrong room. So why not bring people from all over the country? I mean, there's great people and resources we all use here local, but when you can get the best of the best around the country, that's really when you make a difference in all these major changes going on. Who wants to go into how these brackets really work briefly?
Tyler, I think I'm going to turn that one over to you.
Sure. So, I mean, understanding your tax brackets, it's a very simple concept. So basically, when you eclipse into another tax bracket, all of your income is not all of a sudden magically taxed at some new number. That would be outrageously unfair, and it would incentivize people to try to keep their income at very specific levels. So what ends up happening is you cross into different effective tax rates on your way up to that maximum rate of 37%. So you might have some of your income taxed at 0%. Some of your income is going to be taxed at 12%, 24%, 35% on your way all the way up to this max tax bracket. So understanding where you fall in that and utilizing those rates to the best of your ability can be a fantastic tool. And where we've seen this come into play a lot in our careers and where we can really make a big difference and help people out is whether you have people that have maybe, on and off income. Not everybody earns the same amount every year. You have some self-employed people. They may go from making 50,000 one year to 250 the next year, or even people in retirement who maybe their income's a little bit volatile as well with, like last year, not having to take an RMD. So what we try to do with those situations is we try to say, okay, so you're used to being in a 35% tax bracket or a 24% tax bracket, but we're not going to hit that this year. So what can we do this year to really take advantage of you having this wider tax bracket? And something that we brought to a lot of our clients, and it's been a great strategy, is Roth conversions. We take a lot of their retirement money that is already in these pre-tax accounts that they would be drawing on in retirement and paying taxes at a later date where God only knows what the tax rates are going to be. We have them convert those funds into Roth, take advantage of these lower brackets that they're not used to getting, and those taxes are paid. That's done. That's free and clear money for them when they're at the end of the road and ready to stop working.
And so if they're in a 35% bracket, not only are you doing that from that move from a pre-tax to tax-free, but on the margin, you're saving them 35 cents on the dollar as well, right? I mean, by making some moves and if you've got that room in the marginal rate bracket.
Yeah, I mean, a lot of the times it's just the assumption that rates will be higher. If I have somebody who, because of COVID, is a restaurant owner and they're barely going to pay any taxes this year, but they're used to making well into the six figures, why not cash in on some low rates when we know what we have? Because my bet is when they retire, even in retirement, their tax bracket's going to be higher than what it just was. We all agree on that for sure. So how long are we supposed to keep all these receipts and data?
So we typically tell our clients, the IRS is allowed to audit you 3 years from the date you file the return. And so we typically just ask our clients, to do a 5-year hold on your, tax records and tax returns. And we also, clients of ours, we have their records. We keep them for 7 years. We keep it both electronic, and now we're keeping everything digital as well. But that's kind of what we tell clients. 5 years is from the date you file.
Awesome. And let's go on the next topic here about how, storing. Obviously, you guys store, and we all give the advice to keep all this important stuff and safety deposit boxes or fireproof safes, even if it's digitally, because the last thing you want to have is your stuff on a thumb drive and then poof, the place go up in fire and you're like, oh my God, where is it?
Right. And a lot of this really comes down to just like the digital age has changed things quite a bit. So look, for our own clients, we maintain digital files in perpetuity for everybody. That's all being saved. So we have copies of W-2s, 1099s, tax returns, all that stuff going back to when we started scanning all these things in. But, for clients that want to maintain their own records, there's just a few things I would say. I mean, look, cloud-based storage, as long as you're confident in the provider and that you're confident in the safety of it, that's going to be your best friend because it avoids all the things you just said, fires, losing things, somebody taking something unwanted. And just when you're sharing your information, it has never been more important to be taking advantage of secure ways to send your information. If you need tax returns, that's something that we always try to send tax returns to clients through encryption, just because you have no idea what somebody could do, what kind of damage they could do with identity theft by getting their hands on something as simple as a W-2 or, God help you, a copy of your tax return. They could really wreak some havoc. So, storing all these things in a secure way and adapting to that digital age and sending things and requesting things through secure formats has never been more important.
That's big. Encryption and two-way authentication, back to these cloud-based things. I mean, the facts are, they've got to have access to your account and your phone, simultaneously. So that's just safekeeping. So let's dig in a little deeper. What are some other, deductions and things that are out there that maybe not be as evident?
Well, what we've been really finding this last couple of years, once the tax laws changed with Trump, is taking advantage of qualified business income deductions for businesses and maximizing it by making sure salaries are at the right level and making sure we have we analyze the overall income, the type of entity there, or the type of, whether they're a specialty or, allowed to take QBI, then we go through all of the different analysis and stuff. But, we do qualified business income analysis. We'll do cost segregation studies. We, looking for all kinds of different, so there's lots of different.
Charitable planning, I know we're working on.
Charitable planning, working on for some clients that have some big events going on right now. So yes.
Awesome. So let's talk about what happens with a W-4 when either people wake up and they get a big aha, a bunch of taxes, or they get a big refund, either or.
Yeah, so a lot of times when somebody changes jobs or when the government goes and tweaks wage tables, that's when a lot of the times we'll see people come in and they'll just be blown away that they happen to owe money. They've never owed money. This must be a mistake. And a lot of the times it comes down to this W-4s. I mean, when you switch jobs, when you sit down and you fill out your paperwork, that W-4 is telling them how to withhold taxes from you on your paychecks. And that's what's going to really determine where you're going to end up being. And we see all the time people fill these things out incorrectly. And all of a sudden you have somebody making $50,000, $60,000 a year and they bring in their W-2 and they've had less than $1,000 in tax payments. And you're going to owe in that situation 9 times out of 10, unless you got a lot of kids. So it's one of those things, like if you're somebody that you're not entirely sure how to fill it out, not sure what to do, and you're not necessarily living paycheck to paycheck, I always recommend claiming zero. Let them take out the most amount of taxes that they'll take out for your level of income, and you're going to get it back. But sometimes, having that tax refund coming your way after April 15th, around April 15th, as opposed to getting completely surprised and owing a few $1,000s that you don't have, is always preferred for me. So I highly recommend going zero just to make sure you're being conservative and safe.
Talk about 401k. This has been around quite some time, and people that own businesses or their W-2 employees, if they make $100,000, they put in $20,000, they're only effectively paying the taxes on that 80.
Yeah, I mean,
why is it such a good tool, guys?
Yeah, 401ks are great, especially if, nowadays with itemized deductions being limited and stuff like that, 401k for a lot of people that are W-2 employees might be their best way to reduce their taxable income. And then 401ks, you have flexibility with them as far as you can do some traditional, you can do some into Roth components of it, to split it up, to have some down the line diversification. And in addition to that, a lot of 401k plans offer you they have loans that you can borrow against yourself and not have to withdraw and pay penalties and stuff like that. So 401ks are a very, very good tool to use. And if you own your own company and you set up 401ks, I mean, setting up a solo 401k, you can put in maximum retirement and do it a lot easier ways instead of having a SEP, which is limited to income. 401k, you got the deferral component and the profit sharing component. So they're very good plans.
Awesome. Let's move to the next piece. Just IRAs. If you don't have a 401k through your employer or through your company, and you have an IRA or can qualify for a Roth, those are another examples, right?
Yeah, so IRAs, you do have to be a little bit careful, and that's something that, if you have questions, you could always reach out to your tax provider as well, because there are a lot of rules with IRAs if used in conjunction with maybe a high earner that you're married to, or maybe you have a 401k. But the gist of it is, if you don't have other retirement plans, you could put money into an IRA. That can be either a traditional IRA where you get a tax deduction up front, or it could be a Roth IRA where you get no tax deduction at the moment, but when you need that money, when you go to take it out in retirement, the taxes are already paid. That is free and clear money, which is a fantastic asset to have in your arsenal at retirement time. So, IRAs, they give you, the amounts aren't going to be as high as a 401k. You can only do 6,000 into an IRA or 7,000 if you're old enough to do the catch-up component. So it's not going to be as impactful as putting, 19,000 plus into a 401k, but still, it's a great asset to have this at your disposal. And one way that we utilize this quite frequently is we have have a lot of people that they think that they can't do any Roth money. They think that they can't put money into Roth because they've made too much and they've already maxed out their retirement for the year. But if you're somebody who wants to put as much money into retirement every year, a great potential option for you is what's called a backdoor Roth conversion, where even if you've maxed out your 401k and that 401k had a Roth component, but you want more money in Roth, you and your spouse could each max out by putting that money into your Roth account through a backdoor conversion, which even if you have other qualified plans, or if you've maxed out, or if you're over those income thresholds, you can bypass all of those under the right circumstances. So just again, follow up with your financial advisor, with your CPA, to make sure that you can work that in the appropriate way. But that's a fantastic tool that we use for our clients all the time.
And let's talk about flex spending accounts and why that's a good tool briefly.
So, I mean, flex spending accounts are mostly with larger companies, and they're, you know, with the rise in healthcare costs and stuff like that, and higher deductibles and stuff like that, you know that you're going to have out-of-pocket medical costs. And so if you're taking it out pre-tax at your job and not paying income taxes on it before you use it, it's just a real good benefit. So maximizing your FSAs is always a good idea.
And then explain to people the difference, if you can, Tyler, between just a HSA and an FSA.
So HSA is going to be specific in the fact that it's restricted in the way you spend it to health costs. So HSAs are bar none if you qualify for them, which you have to typically be in a specific type of health insurance plan, usually a high deductible plan. Now, if you check that box and you are able to fund these HSAs, these are the best resource that you can have, because they're, you know, we're talking about traditional versus Roth IRAs. You got to either, you know, you get a tax deduction now and you're taxed later, or you get no tax deduction now, but you're not taxed later. HSAs, you get the tax deduction, and then when you take it out, you just have to use it for what it's supposed to be used for health expenses, whether that's prescriptions, doctor's visits, copays, whatever that may be, and you never get taxed on it. So from that perspective, you are completely avoiding income tax on money that you designate for these funds. There's even specific ways that you can just hold and reserve all of your health costs, keep all those receipts, and then reimburse yourself in a year when you could use all that cash. There's a lot of great ways to use HSAs. It's definitely a favorite of ours from a tax planning standpoint.
So what are some other often overlooked areas that folks forget about?
So a couple of the ones that are probably less heralded, less common, you've got adoption costs. So if you're looking at adopting, certainly that's something that you should be reaching out, doing some homework and seeing, okay, because there are pretty substantial credits that you can get back because
is that still 10
adoption
grand?
is
Because I know
process.
I adopted a baby. Is it 10 grand still roughly?
Yeah, there's
so,
income limitations, but they're generally pretty high, and the credit is really good.
Yeah.
So yeah, you get credit costs there. We've already kind of touched on college education plans, but not so much a deduction, but another avenue for that is 529 plans or Louisiana Start, specific to our area. You put money into retirement accounts now, let it grow for the next 10 years before your kid goes to college. And again, when you take that out, you're not going to pay taxes on the growth. Capital losses is something that not everybody always thinks to capitalize on. So, I mean, if you invest in something, if you put money into a buddy's company or a stock and it goes belly up, you might have a capital loss there. If you donate non-cash goods, that's like your Goodwill items. If you donate furniture, if you donate a vehicle, that could all, you might need appraisals in certain situations, but again, that can be a great thing to have in your arsenal. And really, most of this presentation has been geared towards individual returns, your 1040s, your basic individual returns, where we do more planning, honestly, and where we feel like we have more, ammo in our arsenal to do these things is with the businesses. I mean, we really haven't even gotten to touch on that, but that's where we find that we can be even more impactful beyond the individual returns. But obviously we find that we earn our keep on the individual returns as well. But those business returns, like you mentioned, that client earlier that we had dealt with, saving $30,000 a year, those are our home runs typically, but we find that we can be very effective in those situations.
There's only so much you can do as a W-2, but as a business owner, there's a lot more wiggle room and strategies you can implement. And I think that's obviously one of the takeaways from today is if you have an accountant or somebody doing your tax and you just know that you're probably leaving money on the table, these gentlemen are willing to do just an eyeball check on a complimentary tax return review on 1 or 2 years and just see. And that's what they did for my particular client. 30 grand a year is, quite some savings to not send to the Department of Treasury. So let's talk about 1031s and what real estate investors do to not pay capital gains, Stephen.
So 1031s are great. And while they're still in the tax law, taking advantage of them is a good idea. I mean, 1031 only happens with real estate, and a 1031 exchange is basically if you sell something at a gain, you have the opportunity, if it's a real estate sale, to roll that gain into another piece of property and defer that gain. And the benefits of that are obviously if you want to then recognize it when you're in a lower tax bracket, or defer it till if your kids inherit it, then they'll never pay tax on it because you're going to step up in basis. So, if you have a highly appreciated real estate, a 1031 exchange is a very good idea upon sale. And there's lots of rules, but we can help you step through those.
Yeah, and one of the things you don't want to experience in your life is avoiding to take an RMD. Tell briefly to the audience why that's a major if they overlook an RMD. I mean, it's a serious penalty, right?
Yeah, and that is where we actually need the financial advisors to help us as well,
Right.
Jack, because having the age and all of that. But if an RMD is not taken, the penalties are significant on the withdrawal then, and the IRS is not friendly with it. So that's also a good reason to have some raw components so you can avoid
having the team.
And
having
then
the team.
Yes, having everybody, having more than one, having availability, because yes, you don't want to get on the bad side with the IRS with not taking it when it's required.
So tell the audience, why they want a custom CPA versus just a run-of-the-mill person that's going to do a boilerplate approach to tax planning or so forth and so on.
I mean, look, I think you could find a lot of CPAs out there that are, good at what they do, but a lot of the times what we end up finding is the experience that they're used to with their CPA is it's purely reactive. It is purely, here's what I made last year, and they go ahead and just put it on the tax reforms on the right lines, and they just let you know, this is what you owe. Our approach is different because when we sit down that first year, when we review your tax return, the first thing we do is we assess the situation and we say, is the situation you're in actually the best one for your business? And what could we be doing better? And so we like to take that comprehensive approach. And that's when we start looking at, okay, is our entity selection the way that it should be? Are we taking advantage of Roth components and things like that in a way that we could be? Are we taking advantage of vehicle costs in the way that would be appropriate? Do we have the right retirement plan for our business where we're maximizing our deferral versus the cost? And when we start to bring these things up to people, more often than not, they get very wide eyes, a little bit overwhelmed, and we tackle it one thing at a time and get them into that perfect situation. We work with a lot of great businesses, and that's my favorite thing on earth when we can sit down with them, put a little bit of a wonky plan in place, and they go home feeling like they just got 40 grand in their pocket, and that's the way we like it. And
the other thing we do is, when we do that, we also make it as easy as possible on them to change their plan because, like Tyler said, they get that wonky eye. Well, we work with the payroll company. We take care of getting that all set up. We meet with, to get the QBI established the best and working with them and with the experts to just make it easier.
Yeah, you hold their hand. That's what I've noticed in meeting you gentlemen. And these are just some of the things that you can go where we got some of this data. And as Tyler said, we did some basic stuff in advance for the W-2 wage earner, but where they really shine is if you have a business and you need some help of not keeping transferring money to the Department of Treasury, and you just know deep down you're paying too much in tax, give these guys a contact and let them just take a look at what you're doing. And if they can add value, they'll tell you. If they don't think they can add value, they'll certainly tell you. We want to thank you guys for attending this webinar. We hope that it's been informative. It also has been something to call you to action, because I know deep down you've probably been thinking, man, I know I can be doing better. And again, Tyler, Stephen, I want to tell you all thanks for what you do. And
thank you, Jack.
I really appreciate you guys being on this. And for all of you, take advantage of the expertise that these gentlemen offer, and it'll be worth its weight in gold.
Thank you, Jack. Appreciate it.
Thank
Get
you
it
all.
in, Jack. Thank you.